What if your low income years actually offered the biggest financial opportunities of your life? Sabbaticals, mini retirement, or even early retirement might seem like the wrong time to focus on taxes, but these periods can unlock strategies that can dramatically reduce your lifetime tax burden. When your income drops, powerful tax opportunities emerge, but only if you know where to look. In this video, I'll walk you through 3 tax strategies that transform lower income years into a launch pad for long-term wealth. These are strategies you won't want to miss. I'll show you exactly how to balance these strategies against one another, because being too aggressive with one could cost you the benefits of another. Now, before diving into the strategies, let's talk about one crucial mindset shift. Most people approach taxes year by year, and this approach almost guarantees you'll miss the bigger opportunity. Here's what I mean. We typically think about taxes 1 year at a time. Think about that question your accountant asks: how can we lower your taxes for this year? So we stuff money into pre-tax accounts, chase deductions, and delay income just to shrink what we owe the IRS in April every year. But this mindset is short-sighted, especially during those low income years. When you're earning significantly less, your tax bracket is likely much lower. Instead of minimizing your taxable income, this is often the perfect time to intentionally recognize income at a steep discount. It's a shift from asking, how do I pay less taxes now, to asking, how do I pay less over my lifetime? That's the real game here, reducing your lifetime tax burden. If you're on the path to financial independence, you'll likely experience wide swings in income, peak earning years, sabbaticals, part-time work, and even early retirement. By navigating these dips strategically, you can unlock opportunities that most people miss. But this isn't as simple as just flipping the script on traditional advice. It has a bit more nuance, and I'll show you exactly what I mean. The government has given us powerful tools to save money when our income is low, but you have to know which ones to leverage at which times to maximize your benefits. Let's start with the first tax strategy for low income years, ACA subsidies, also known as the premium tax credit. Now, this strategy only applies if you get health insurance through the Affordable Care Act marketplace. If you have health insurance through other means, feel free to skip ahead to the next strategy. I'm covering this first because it works against the other 2 strategies that we'll discuss later. When you get health insurance through the ACA, your subsidy eligibility is based on your modified adjusted gross income. Now, for people in low income years, especially early retirees, sabbaticals, or anyone working part-time, your income might be low enough to qualify for substantial subsidies. And these aren't small discounts that I'm talking about. The savings could be up to $30,000 per year in health insurance premiums alone, all depending on your state, family size, and income. The US average is going to be closer to $12,000 of savings per year, but still a remarkable amount. Now, why such a big difference between $12,000 and $30,000? It comes down to how the subsidy is structured and your state health insurance costs. So under the current law through 2025, your ACA premiums are capped at 8.5% of your household income. This means if you live in a state with more expensive health insurance, like these 10 on screen, you could receive a larger subsidy simply because the plan costs more, while also being capped at 8.5% of your income. To help illustrate the potential savings, consider this example of a married couple living in Burlington, Vermont, the most expensive state for health insurance. With an annual income of just $30,000 for 1 year, they could qualify for over $30,000 in yearly subsidies. At this low of an income, they could bring their premium costs down to 0 if they selected a silver plan. Even at a more moderate income of $60,000, they'd still receive $27,193 in subsidies, paying just $287 per month in premiums for a silver plan. As you can start to see, these savings diminish as your income rises. Even worse, in 2026, the law is scheduled to reintroduce what's known as the ACA subsidy cliff. This means you'll you'll lose eligibility for subsidies if your income exceeds 400% of the federal poverty level. The 8.5% cap will no longer apply to those above this threshold. And for reference, here's a table that shows the federal poverty level in 2025 based on your family size, as well as showing what 400% or 4 times the FPL would be in the far right column. For perspective, a Vermont couple earning just 401% of the FPL, so just above that anticipated ACA subsidy cliff, will lose about $23,670 in subsidies in 2026. Now you can see why optimizing your premium tax credit gets complicated, especially with the potential return of the subsidy cliff next year. My advice for optimizing ACA subsidies is twofold. First, determine exactly how much subsidy you're eligible for based on your location, household size, and various income levels. The Kaiser Family Foundation ACA subsidy calculator, the one I've shown just recently on screen, is the best tool I've found, and I'll link to it in the description below. Second, carefully weigh the trade-offs between decreased subsidies and other tax saving measures that might increase your income. Don't just focus on this year's savings, balance the immediate ACA subsidies with the future tax advantages of other strategies that I'll mention next. So now let's move on to explore the other 2 strategies for low-income years that will start to have long-term savings. The next strategy is tax gain harvesting. This strategy only applies if you have investments in a taxable brokerage account. If all of your investments are in tax advantage or retirement accounts, this won't apply to you, but understanding the concept may still be helpful. Most people are familiar with tax loss harvesting, selling investments at a loss to reduce your taxable income or to offset gains, but tax gain harvesting works differently. Tax gain harvesting is when you intentionally sell appreciated assets, not to trigger a tax bill, but to potentially pay 0 tax at all. After selling, you can immediately repurchase the same investment because there's no wash sale rule, maintaining your market position without missing any future growth. This may sound too good to be true. How is that possible? When you hold an investment for longer than a year, the gains are treated as long-term capital gains, which receive favorable tax treatment. And in low-income years, the long-term capital gains tax rate can drop to 0% for income up to certain thresholds. For 2025, that's $96,700 for married couples and $48,350 for single filers, without accounting for the standard deduction. So when you include the standard deduction for married couples filing jointly, you can have income and gains totaling $128,200 or $64,100 for single filers before paying any tax on your capital gains. So instead of avoiding gains or reducing income, tax gain harvesting allows you to lock in those gains now at 0% tax rate and reduce future taxes by resetting your cost basis if you sell those investments later during higher income years. This strategy is particularly powerful during low income years like early retirement, sabbaticals, or semi-retirement because you can realize gains strategically while staying under the 0% threshold. So most tax planning involves judgment calls about whether you'll pay less in taxes now or in the future when rates are just unknown. But with a low income year and a 0% tax rate on long-term capital gains, it's virtually guaranteed you won't find a lower rate than 0%. At least I don't think the government will ever pay me to realize gains. There are a few important considerations when harvesting gains in your taxable account. First, in years with no other income, you can use gains to generate just enough to meet the minimum threshold for ACA subsidies. I didn't mention this earlier, but just as there's a ceiling for ACA subsidies, there's also a floor, a minimum income required to be eligible. Equally important is monitoring how capital gains might increase your modified adjusted gross income above the ACA subsidy ceiling, especially with the anticipated return of the subsidy cliff in 2026. For example, if you have $0 in active income, are on an ACA plan, and want to harvest capital gains, be mindful of how the recognized gains affect your modified adjusted gross income. If you realize $90,000 in gains as a married couple, the tax rate would be 0 on the gains, but it might push you over the subsidy cliff in 2026, potentially costing you more in lost subsidies. As we saw with the Vermont couple example earlier, this could mean a difference of $23,000 in premium tax credits. That would create an effective tax rate of 26%, though in most states it would be closer to 13%. I still recommend finding a right balance that allows you to recognize gains while also preserving your ACA subsidies. The third strategy is especially powerful during low-income years, Roth conversions. This strategy involves moving money from a traditional IRA or 401k into a Roth IRA. You pay taxes on the converted amount now, but that money and all of its future growth will never be taxed again. During low-income years, Roth conversions are particularly valuable because you can pay taxes at a lower tax bracket while also guaranteeing tax-free treatment for those funds forever. Any low-income period creates a strategic opportunity window. You can strategically fill up those lower tax brackets with those conversions. For example, if you have $30,000 in active income this year, but the 12% bracket extends to $48,475 for a single filer, you could convert up to $18,475 at just 12%, giving that money a lifetime of tax-free growth as well. And with the standard deduction as a single filer, you could convert even more at this favorable rate. Triggering a tax bill now might not sound that appealing, but here's the key. Paying 12% now is better than paying 22% later, and it could be even more than that. And it might even be possible to do Roth conversions without paying any taxes at all. If you had zero income in a specific year, you could convert $15,750 for single filers or $31,500 for married filing jointly in 2025 without paying any taxes at all. Roth conversions also reduce your future RMDs, or required minimum distributions, especially important if you have a substantial tax-deferred account balance. Additionally, these conversions can lower your future Medicare premiums, they can reduce taxes on Social Security benefits, and provide greater tax flexibility in retirement. However, there are important considerations. Just like tax gain harvesting, Roth conversions increase your taxable income, which would potentially reduce or eliminate your ACA subsidies if you're not careful. My advice here is to apply the same caution as realizing capital gains. Another consideration is that Roth conversions require paying taxes on the converted amount, which actually may deplete liquid assets when you need them the most. Alternatively, you could also pay taxes from the tax deferred account that you're converting from, but that would incur a 10% penalty for the tax payment portion if you're under age 59.5, since it would be seen as an early withdrawal. Finally, converted assets aren't accessible penalty-free for 5 years, so consider this if you might need those funds sooner. Roth conversions definitely involve more complexity and nuance than the other strategies, and it is third on the list for that reason. It's often advised to consult with a professional before pursuing Roth conversions. But make no mistake, under the right circumstances, they're a powerful tool to reduce your lifetime tax burden. They can even fund early retirement penalty-free through what's known as the Roth conversion ladder. This is one of the 2 most popular strategies that early retirees use to fund early retirement from tax-deferred account. If you want to learn the best way to fund early retirement, watch this video up here. And as always, thanks so much for watching and enjoy the journey.